Hi everyone, thanks for coming along to London New Finance. This is our December meetup, and our first speaker will be Simon Dixon.
Hello everybody. For the next 10-15 minutes or so, I'd just like to present on what we're up to and also how that might fit in with some of the stuff that you're up to. So I'd love to hear from you. If we haven't met already, my name is Simon Dixon. I wrote a book which is about to be published next year, which has taken me about a year to write. And it's titled Bank to the Future, Protect Your Future Before Governments Go Bust. And so when all this Eurozone crisis started to happen and the US downgrade started to happen and the Italy and everything else, I thought that's leverage enough to make sure I get that book out there, because I was talking about that happening before it did happen. So for the last 5 years or so, I've been working on banking reform and working with at the governmental level, at the political level, at the non-for-profit level, more of a social mission. Before that, I had a career in where I started as a stockbroker, and then worked in a trading role for an investment bank on the London Stock Exchange, and then went into investment banking before starting to set up my own little business. Now, I guess Bank to the Future was born out of knowing how hard it is to get venture capital funding, know how hard it is to attract angel investors, and going through all those experiences myself, and also having worked with larger companies that are looking to raise funds, and then small companies that are looking to go public as well. And it's all come together really into this little mission that we call Bank to the Future. I set up a training company for students and graduates, and some of my clients are here today. Hello to you all. And that went on after, well, firstly we got angel investment from a gentleman called Peter Hargreaves, who some of you may or may not know. He founded a company which was founded in his bedroom, and 25 years later he floated it on the FTSE, and he's now worth 1.3 billion. So it's a pretty good angel to have, and I've learned a lot from him. And after getting the training company to work, it got us a lot of access to lots of different universities, because it was a training company working with students who want to work in investment banking. And that also gave us access to a lot of different universities. So I started presenting on some ideas that we've been having as we're what we call banking reformers and monetary reformers. And I work with a not-for-profit, and we put together some legislation that we got in front of the Independent Commission on Banking recently about a few issues that I'll probably go through of why that relates to the business. But yeah, so we put those in front, and we got a little bit fed up with speaking to politicians about how banks should look and how we think they should look in the future. And so the response was, why don't you go and create something and come back to us? And so we did, and so about a couple of years we've been working on what would an alternative model for banking actually look like. And it was really born out of the mission to create some kind of disruption in the financial services. I know it's something that a lot of people are working on right now. And I'm really excited about that, because the last week I got an opportunity to speak to some friends from Silicon Valley, and they were talking about how the VC model is really struggling to find the funds right now, and how the private equity model are really struggling to find the funds right now, and how we all know about the banking model, how they're having some massive regulatory changes, which is restricting the ability for them to lend to small businesses, and they don't really want to lend to small businesses as well. So that's the background. Now we about a year ago I started putting all my personal money into it, and I wanted to see how far I could get without a VC and without an angel. And so I'm fully invested in this right now. So we need to launch in March 2012. And the model that we've put together is, for those of you that are familiar with this space, over the last 8 years, there's been a lot of innovation in alternative financial models, which kick-started with Zopa, who put together the first model for peer-to-peer lending. And there's been a whole load of models since then. And we wanted to create a model which really puts together the last 8 years of innovation and combine that with a lot of banking experience as well, and we've attracted a really, really great team now to put this together. And so here's the model that we're going to be launching in March 2012. For some reason my slide doesn't want to change. It was working earlier. The other computer doesn't have my slides on. There we go. Okay, so BankToTheFuture is what we wanted to do when we looked at all the different models for finance. We recognised that depending on where you're at in the business, raising funds for your business stage, one platform might be good for you, another platform might not be right for you. For example, if you've got a good credit rating, then you might be able to raise funds on a certain platform. But if you don't have a good credit rating, or you're new to business, or if you're an individual and you're not a business, we've seen lots and lots of little niche platforms turn up. So we wanted to create one that was just for the productive economy. We only wanted to fund people that are going to make some kind of value or contribution or put something new out there in the world. And so that's why we focus on the productive economy, which is the sector which is the most underfunded right now. Banks only put about 8% of their capital towards the productive economy. 91% goes on property speculation and unproductive economy and personal loans. So the first product that we want to launch is what we're calling well, how many of you are familiar with the crowdfunding model? If you could raise your hands, pretty much most of you. So crowdfunding is, we think it's most appropriate to somebody that hasn't quite got a credit rating, they haven't quite got a business, they've just got an idea and they probably don't have the experience to turn it into an investable business at this point. So we think it's really, really good to cater for those people that are sat at home and taking advantage of the environment we're in today. And the environment that we're in today is that if you've got a laptop, a smartphone, an internet connection, you're in business. And that's the nature of the beast today, because the social networks and technology have completely changed everything. So the startup cost of starting something up today is significantly reduced, and we think that crowdfunding is the best model. So for those of you that haven't heard of it, an example might be, let's say you wanted to start a film, and in order to create that film you needed $5,000, but no one's really going to invest in you or lend you money because it's not really an investable proposition at this point. So you reach out to all your social networks and you get 5,000 people or 500 people to give you small contributions, or someone could give you a large contribution as well. The beauty of it is that you actually get a ready-made team of people that are invested in your success. And that's the beauty of crowdfunding, as opposed to getting one investor on board or getting one person to give you the money. But what you do is you offer rewards, because you're probably not going to be able to pay it back. It will put too much pressure on you, and you haven't got a business which people would probably invest in. So you say something like, if you give me a tenner, then I'll feature you in the credits of the movie. Give me 100 quid and I'll film your next movie. Give me 500 quid and we'll put you in a feature role in the movie, or whatever it may be. And what you tend to attract people that like you, like the mission, like what you're up to, will have a similar interest, and you can crowdsource all that information together. And there's your team to make it happen, really. So we think it's a really good way to get started. But you can only attract so much capital that way. So far the record, and this is a record, is more of an outlier, the average would be about 3,000 odd quid in this kind of project. But somebody has attracted $940,000 through such a project, but that was the record. So the second is we're looking at, if you want to attract a bit more capital, you probably need to give people a return on their savings. However, the downfall of this model is you need to be creditworthy. So we think that for those who want to invest in growth, we think that borrowing the money is one of the best ways that you can actually do that, or there's an alternative, which is the third model we're doing. So the second model is we think that borrowing money is really good for growth capital for a business that has a credit rating. If you have a credit rating as a business, you've probably been trading for about 2 years. And it's really important for us to only pick people that have a really good credit rating for this product, otherwise the whole model falls down, as we've seen some of the crowdfunding peer-to-peer lending platforms. One of them recently did actually go down because they weren't tight on their credit ratings. So what we're going to be doing for the second product is, if you're the way that the peer-to-peer lending model doesn't work. Is anyone familiar with the peer-to-peer lending? You can raise your hand if you're familiar with it. I know we've got some of the founders of the model here today, so most people will be familiar with it. But essentially, it's pooling together people that want to borrow and people that want to lend. So if you need to borrow 10 grand, that might be spread across 500 different borrowers. You set the interest rates, and it matches up with people that are willing to pay and borrow at a different at that interest rate. So what the model has proven so far, a couple of things. Firstly, they've had better default rates than ordinary banks in the financial crisis. The reason being is we've seen that people, when they know people and who they're lending to, they've felt some kind of social pressure to repay their loan. From what I've heard from the other companies that operate in this space, is that people have called them up and said, look, I'm in real financial trouble, I'm willing to default on my Barclays loan, I'm willing to default on my credit card, but I'm just not willing to default on this loan. Because, you know, and so it's brought back that relationship that got lost in the modern world of banking, essentially. So that's a second type of product. So you can attract more capital by actually offering people a return on their savings. Really attractive proposition in the current environment where it's really hard to find any kind of return on your savings. Now the third model, which we think is particularly interesting, and this is how we want to scale this model, because at the moment, with growth capital, you're looking at being able to borrow around about 100 grand. Some platforms will allow you to borrow about 250 grand if you put some kind of security in the loan. But the third model is looking at an alternative to venture capital, which is where you offer equity. Now here's where we think the most scale is in the model, because recently a crowdfunding world record occurred in the last few months, and that was a business valued at 10 million managed to raise £1 million, all through crowdfunding. And that was by offering equity to people that they'd love to be a part of that business. So what we're going to be doing is, in February, we're launching our very first crowd fund. Is going to be our own platform, because we only want to raise funds in this way. I think it's a much better way of raising funds. So you reach out to the crowd and you offer equity. So we're going to be raising £250,000 for 10% of BankToTheFuture. And the reason that this is such a good model is because you end up with a team of evangelists for your brand that all invested, they've all got equity, they've all got a reasonable part of that business. And they become your team. Now, one of the downsides that people think is, how do you manage that many shareholders? Say you had 100, 200 shareholders. Well, that's where the platform actually comes in. We allow you to manage the whole process of managing your shareholders, updating your shareholders, and really tapping into the collective information of all your shareholders. So we think that this is a really good model, which is crowdfunding in exchange for equity. And the reason that we like this is because the limit of what you can actually raise through this model is going to be limitless. So at the moment the record's $1 million. We're looking at what would it take to get 2 million? What would it take to get to 5 million? What would it take to get to 10 million? What would it take to get to 25 million? And all of a sudden, I was speaking to those contacts from Silicon Valley, and they're saying that this is without a doubt the future of the venture capital, the business angel industry. Even having a place where you can manage all your business angels within a platform. So what we've created, this sounds quite complicated, but we've created a very seamless social network where you can simply tell us a little bit about your business, and we can tell you what type of product you should be raising and how you should be structuring that. We've also integrated what we're calling a social capital, and I'll tell you a little bit about that on the final slides just before I finish. But plans for the future is we actually want to create a genuine alternative to banking. Now, while this is all very exciting, it's still not an alternative to banking, because at the end of the day we all need to put our money somewhere and we all need to get paid, and the only way you can get paid is if you give your company your bank details. So we were looking at what is wrong with banking at the moment and why do we think that they're going to be in a lot of trouble, and we wanted to put together and structure with the financial technology innovation companies how you would actually apply for a banking license. And so we've started that process, and that's going to be our second round of funding to do that. So what we're actually doing is it's really, really simple. We want to create a bank that works the way people think banking works. And the way that people think banking works is an intermediary between borrowers and lenders. Well, in fact, a bank doesn't work like that. What we put in our propositions when we were speaking to the government of how to reform banking is we asked for three things. The first thing we asked for is when we researched banking, it turns out that when you deposit your money with a bank, they become the legal owner of your money. It's not your money, they own the money when you deposit your money with a bank. The second thing is when you deposit your money with a bank and they become the legal owner, they actually allocate that money as you wish, and as we've seen, 91% of that goes to property speculation and commodity speculation and socially harmful things because they choose profit over profit, people and planet, what we call a triple bottom line, which most of the social banks would actually decide whether they lend or not. So we wanted to create a model whereby you could actually just own your own money. We wouldn't touch that money. And that money is called a current account. But at the moment, the bank's current account, they become the legal owner. So we wanted to provide somewhere where simply you just put your money there and we don't use it. It doesn't require a government bailout. It doesn't require any kind of governmental guarantee because we're not going to touch it. We don't need to touch that. It's separated, it's off balance sheet. It's got nothing to do with our money. But if you want to actually get a return on that money, this money won't offer a return. Then we want to transfer that money across to an investment account. And an investment account provides the liquidity for the loans where you'll actually be, you can either do it in a couple of ways. You can automatically be matched, or you can select the type of businesses that you want to invest in. So the money from the investment accounts will only be used for the productive economy, and you get to see exactly what your money is being used for. You can be on, you can be hands-on, or you can be hands-off. But if you're hands-on, then you can actually contribute to seeing if you can make a success out of that particular venture, and there'll be a number of different ventures. What we found is that a lot of people really like the thought of being sat at home and with 100 quid being a little venture capitalist. I find that a very attractive proposition. And now that's possible because of technology. And so that's the model that we're looking to create. So very quickly, I'll probably run out of time, have a tendency to overspeak. The fundamental principles of what we're trying to create here, and what we will be creating, is that when you put your money with BankToTheFuture, the money is actually yours, as opposed to the money being the bank's money. You know what your money is actually being used for. We're increasing transparency. We're trying to meet a number of governmental objectives in the way we do this. And we also, you know that your money will be used to build productive things. It won't be used to go out there and people to refinance their debt and buy shoes and everything else that almost all of the money is being used for at the moment is. We think it's a little bit crazy that if you go into a bank, if I go into a bank right now and I ask to borrow 10 grand to redecorate my house, I'll get that loan, no problem. However, if I go into a bank and say, here's the business I want to create, I want to borrow 10 grand, not a chance. I want to do something good with this money, I want to do something productive with this money, not a chance. However, if you want to use it to redecorate your house, fine. We won't be using any of your money in order to create money. So that's the third principle of how a bank actually creates. We believe that the cause of the financial crisis is that banks actually create money. So when you borrow for a mortgage, that's actually brand new money created out of thin air. And we think that that's one of the main reasons that we're in a financial crisis. So we wanted to create that working model. So there's a bit of a social mission there, as well as providing a place where entrepreneurs and investors can get a decent return on their savings at the same time as contributing to the productive economy and allowing some of the great innovation to get the funding that they actually need. One of the things that we are doing, which is the final slide, is that we're also using this platform in order to get some data on social capital. So at the moment, the primary way that a loan is actually measured is whether someone will lend to you or whether someone will invest in you, tends to be a credit rating. We think that that's really good, we think that that's really important, but we also think that there's more that can be added to that data. So everyone that signs up in our social network will be assigned a social capital score. And that social capital score does a few things. One, the people that want to invest in you, they can decide, they can filter. Those with the highest social capital score will be the ones that we'll look at. Secondly, over time, we believe that we'll be able to build some kind of model for how the social capital actually relates to people's ability to repay. It's far too early to make any decisions on that, but we think over time we could actually develop that. So at the moment, we've got some very clever mathematicians and academics in the field that are building out an algorithm now for how you can actually measure someone's online influence, how they behave online, how visible they are on the social networks, traditional credit scoring and traditional ID scoring and peer reviews as well. So that people can really get rewarded for being visible, for being transparent, for being open, and for being connected, because we think that that's going to be a huge part of the future. So that's our model. I don't know how much time I've got, but if you'd like to contact me, I'm very visible, I'm very transparent, and you can get me on any of the social networks and you'll be able to get in touch with me very easily. Do we have time for questions?
Yeah, I think we do.
Okay. How long did I take, I think?
You're at sort of over 20 minutes, but
Oh,
yeah. We can run over a bit.
Question, yeah?
The scoring that you're going to do at the end, the social capital score, are you going to collect your own data, or are you going to use APIs for the data that's already out there to pull it all in and then use that to calculate?
Yeah, so a combination. For credit scoring, we'll be using the API keys of Experian, Equifax, Call Credit, whoever we're using it yet. For influence, there's data out there like Cloud and various other API keys you can access at the moment. But we'll also be collating our own data at the same time and looking to build that out as well. Question from Martin?
When you got all the data out there, how would you mathematically go about normalizing all these scores out, say between 0 and 100, obviously 100?
Yeah.
Do you want the honest answer?
Yes, please.
I've got some clever people that could give you the answer. I haven't got the answer right now, but they're working on some pretty clever stuff.
No, that's
I think, yeah.
Hi, Simon. Your venture capital fund, are you competing with AIM listing? And if so, how's the regulation handled?
Okay, well, it's not quite a venture capital fund. Models have already been innovated of how you can actually get around a lot of the regulatory problems that are faced with offering equity. So we're launching a model which does not require FSA approval initially. It just requires us to partner with an FSA approved firm. And we found a model whereby, which we believe, we were just having a conversation with Simon here today, that the government actually want this. They're very supportive for this. So while if we were in a bull market, there might be a lot more red tape. But what we're actually doing is something that the government actually wants. So yeah, we've constructed a model that doesn't work as a venture capital fund. It's peer-to-peer, so it's people that will be investing in each other directly.
Should
I've
we
got time for one more question.
take one more?
Okay, we'll do one more.
Yeah, there's talk at the moment about sort of privacy backlash.
Yeah.
People sort of decide their own interests. How do you think that would affect the business?
Well, someone that's concerned about privacy just won't use our platform, and we'll tell them to use someone else, really. The model that we're building is for a certain type of person. It's for a transparent person. It's for someone that's not scared of technology. And it's for someone that's happy being transparent. If you're not happy, then you can use the traditional models. We're not really trying to cater for that person straight away.
Brilliant. Thanks, Simon.
Okay.